Here we are, March the 27th, and what a wild day, what a wild week. The markets are finally closed. Here's a quick recap for you. First of all, equity markets. We saw them rallying big time through the week up until today. The market had a major sell-off most of last week, and there was a turnaround this week through the course of Monday to Thursday, and then today had a bit of a sell-off. So we're now back above the 20,000 point on the Dow. But boy, this ride is not over yet. It'll be very interesting to see what unfolds over the coming weeks. The coronavirus cases globally have now they've definitely exceeded 500,000 cases. We're almost cracking the 600,000 mark. There's now more cases, 100,000 cases now in the United States, higher than any other nation in the world. And the Bank of Canada today lowered interest rates by another 0.5%. A second surprise rate announcement since their first and only rate announcement they were supposed to have on March the 4th. So let's recap what's happened here in the month of March on interest rates. So first of all, the Bank of Canada had their first rate announcement and their only rate announcement for the month of March on Wednesday, March the 4th, when they cut interest rates by 0.5%. Then in a surprise announcement on March the 16th, they cut interest rates by another 0.5%. We have now seen the overnight rate go down to 0.25%. I've been saying for months that we're probably heading in this direction, and now here we are, virtually at zero interest rates. Canada Treasury bills have not cracked the negative yield term yet, but we're already seeing that in the US market. Right now, there's no anticipated further rate cuts by the Bank of Canada, but let's wait and see what happens in April. Mid-April, there is another rate announcement of the Bank of Canada. If this situation gets worse, don't be surprised if the Bank of Canada matches what the Federal Reserve is doing in the United States and going to zero interest rates. So what does this mean if you are a fixed income investor? Well, if you're a retail fixed income investor, if you're a private investor using this money for your own retirement funds, for example, unfortunately, I don't have very good news for you. If you have a bond portfolio, your bond prices, especially your long-term bonds, have probably risen up in price quite nicely. But of course, as those bonds come due for maturity and you roll them into new terms, we're going to see those rates coming down lower and lower. If you're an institutional cash management investor, I hope you took our advice earlier. And if you haven't, you got to listen to this advice now. You need to take your terms and term out your positions into laddered portfolios. Take your positions, put them out as far as you can. Don't worry about the rates. Focus on credit quality, focus on diversification, and try and just get something for your returns right now in the event that we do go to negative yields. I posted a video earlier this week about going into treasuries. We're still recommending our clients focus on about a 10 to 20% weighting in Canada Treasury bills, which right now, candidly, are basically paying you nothing. If you're a borrower, of course, lower interest rates are a gift being given to you. Prime rate now is down to 2.45, or if it's not there today, by Monday or Tuesday, the prime rate should be 2.45%. So if you've got great credit, you should be able to borrow from your bank at prime, which is very, very cheap. It'll be very interesting to see once this all settles out, and hopefully we see this COVID-19 curve flatten, whether this is going to have a impact on the real estate sector. Because typically speaking, when interest rates are going down, borrowing costs go down, real estate prices rise. If you're sitting on credit card debt today, do what you can to get rid of it. I know this is a message you probably heard over and over again, but it's especially important now. We've seen interest rates going down and down and down, yet credit card companies continue to maintain these very high costs of borrowing, anywhere from 16 to 19 to 20%. In fact, we've seen groups like the federal NDP calling out the credit card companies to do the right thing and lower that cost of borrowing, maybe mandate it through the federal government. But don't wait around for them to take care of you. You got to do it yourself. So whether it means selling off some assets to be able to pay down that debt, or maybe do a debt consolidation, go to your bank, be active, tell them you need some help, tell them you want to consolidate your debt. It's amazing how much you can reduce your cash outflow when you consolidate debt.